Hi, Les Goss here. Today I'd like to speak with you for a few minutes about a Private Placement Memorandum, or PPM. This is the document you give to your potential investors so they have all the information they need to make a good decision about whether or not to invest in your next project. Now, it does cost a good chunk of change up front, and your odds of getting caught by the SEC are slim. But I hope by the end of this video I've convinced you that it's a good idea to get one and follow all the rules to protect yourself, your investors, and your project. Now, the only reason you need to get a PPM in the first place is if you've created a security. So let's look at that and find out exactly what constitutes a security. Now, in the 1940s, the Supreme Court passed a case that resulted in what we now call the Howey test. This was the four-part test that determines what is or is not a security. All four must be true. There's got to be an investment of money in a common enterprise, expecting to make some money off of the thing, and through the efforts of a single person, a promoter, a syndicator, a third party. In other words, this is you. They're depending on you to make this all happen. If all four of those are true, you've created a security, and the SEC wants to know about it. Now, you can avoid creating a security if you've got a small group of partners and they're all equally involved in the day-to-day operations. Then you have not created a security because it's not dependent on one person, and you don't need to follow any of the rest of this. However, the rest of us need to get an exemption from registration. Now, if everything is in one state, the principals, the investors, the property, then you can just file with your state and get an intrastate exemption, and you don't have to deal with the feds beyond that. Otherwise, you'll need to get an exemption under SEC Regulation D, otherwise known as Reg D. Now, this is a long, complex document that I'm going to summarize here for you. There's just a few things we need to know for this particular video. First of all, it's made up of 3 rules. And these 3 rules, any one of them, if you follow, you get an exemption. They differ in how much money you can raise and how they treat investors, so you'll need to look into which one is best for you and your group and your project. Once you figure that out, you just fill out a 4-page online form called Form D, send that into the SEC, and you are good to go. If you have done this and you've created a security and you want an exemption, please see a securities attorney, not your regular real estate attorney, only somebody who's experienced in dealing with this particular securities law should be involved in helping you make good decisions on this. Now, some people think they don't need to do this because they've got an exemption already. They think that, well, it's just the family, or there's only 3 of us, so we don't need to do all that. I talked to one apartment guru who said he didn't need to get one because he always made sure there was fewer than 20 investors in the deal. Sorry, that's not, according to Regulation D, an exemption. Not advertising is a good idea. It'll keep you out of the sights of the SEC and keep it private, as it's supposed to be. But that alone is not sufficient to give an exemption, nor is forming an LLC with its operating agreement. That's not sufficient to get you an exemption. So what exactly is this private placement memorandum that you need? Well, it's in 3 parts. The first part is the disclaimer section. This is where all the risks, all the conflicts of interest, all the things that could go wrong are listed page after page. And if your investor is still interested because they believe in you and your numbers look good, they'll go on to the subscription agreement, which gives them an opportunity to fill out their necessary financial statements and their experience with this type of investment, their contact information for their advisor if they're using one, and how much money they're going to put into the deal. The last part is the operating agreement of the LLC or whatever entity you're using to run this thing. So the investor is going to sign all 3, indicating they've read this, they've understood it, they feel they're qualified, and they're ready to go. So once they do that, that's good news for you, but still, it could be $10,000 or more to get this thing made up. So it's not cheap, and you've already got your earnest money to come up with, your appraisal, your inspection, and so on. Now, all this money you can get back, you can raise from your investors and get this reimbursed, and you should, but you won't see that money until closing, at which time you'll get it all back. But in the meantime, you do have to come up with this out of your own pocket, which is why some people figure, hey, I'm just a small fish. The SEC is not looking for somebody as small as me, and you're probably correct about that. But you need to consider a couple things. One is, what if something goes wrong? What if the economy totally stalls out? Your vacancy rates don't drop. Your projected income doesn't go up the way you told the investors it would. You can't sell it at the time you thought you would. There's a lot of things that can go wrong and that are beyond your control, frankly. But that's when people call their attorneys and want to know about, is it time to get our money back from you through a suit if necessary? And their attorney will call and want to know what kind of documentation you gave to all the investors. So that's when it's really nice to have this PPM in your back pocket. But there's another really good reason for that, and that is most of these people that are investing with you are your friends, your family, people you want to do business with again. And you really need to make sure they've understood this properly in all its gory detail and still want to sign off and go with you. Now, those signed documents are your insurance policy against them coming back and saying they weren't properly informed. Now, they can still get you if you commit criminal acts or totally neglect the project or something else. But this is designed to cover you just in case something out of your control goes wrong. At least you've given them all the reasons up front that they could possibly, lose their money. So it's really not that difficult to get an exemption. You figure out which are the 3 rules you want to do. You file the 4-page Form D, and then you never have to find out how you're going to look in an orange jumpsuit. So for now, this is Les Goss saying, go ahead, get that PPM. You'll sleep better at night. Thanks.